Hi everyone, welcome to our number 3 webinar. And today we're going to talk about valuation and the importance of understanding valuation. If you're investing in commercial property directly, or even if you're investing through a fund or a syndicate, it's really important to understand how commercial valuation works and so you're familiar with what you're investing in. That's the most important thing. And also, if you're investing on your own or directly, it's important to understand it so you can basically get a good deal, find something you can add value to. First of all, just a quick warning, Provincia is only for wholesale investors as defined by Clause 3 of Schedule 1 of the Financial Markets Conduct Act. So we're just got to say that before we start, and Jack's going to take it away in the next slide.
Awesome. So this is the yield calculation. So probably the most important calculation when you're looking at yield percentage. So that's the best way to compare property to property, is to compare the yield that each property is returning. So that's the quickest and easiest way to basically compare two properties that you're looking at. So that's something we always do initially whenever we're looking at a particular commercial property that we're looking at purchasing. So the way it's calculated is quite simple. It's the net annual rent. So what you want to find is the net annual rent of the property, say 100,000, and then you divide that by the purchase price. So the net annual rent divided by the purchase price gives you the yield. So when we're talking about property, we're talking about 5% yields, 6% yields, and that's based on this calculation here, which gives us a direct comparison between two similar properties that we might be looking at and gives the return. And so when you're looking at property, you might want to buy a property with a 5% cap or a 6% cap. So what you can do is you can adjust your purchase price. And so you go net annual rent divided by the purchase price, and that will give you the differing yield. And you can also rearrange that calculation to get to your purchase price. So something we do is to determine what price we want to pay for a property. We go the net annual rent divided by the yield that we want. So we basically reverse the formula, and that will give you the purchase price. So that's the very basic calculation that we do when we're initially looking at a property to make sure it fits what our purchase price and the criteria based on a yield. So any of you can do that at home if you're looking at buying your own commercial and comparing property with property. So number 2 is, what is a cap rate? So a capitalization rate, so abbreviated to cap rate, capitalization rate. So that is the rate that the valuers apply based on property to determine, it takes into account risk, return in a certain area. And that's what I'll explain this later in a future slide with the valuation methodology. But they use a cap rate to basically determine value, which is based on comparative market properties selling in a particular area. So the purchase price is a yield for a particular building used to calculate the value based on comparisons with similar sales evidence in the area, as just mentioned. So the cap rate percentage equals your net annual rent divided by the value, which we just touched on. So your net annual rent divided by the value, and that gives you your cap rate percentage. And so the value equals your net annual rent over your cap rate. So that's the easiest way to calculate value when you're looking at valuing a property, is simply getting the net annual rent and dividing it by a particular cap rate. So basically dividing it by a particular yield that you want to determine the value you want to pay for it.
Yeah, and a really important thing about this calculation is how can we improve the value?
Yeah.
And when you look at the formula, you can either improve it by increasing the rent or decreasing the cap rate. So decreasing the percentage return that an investor is willing to pay for the property. So in certain ways you can decrease the cap rate, and we're going to talk about that next. And there's also ways you can increase the rent easily as well. So do you want to take all this formula when you're looking at buying something, and also when you're looking at possibly investing in a fund as well, making sure that the fund has got some built-in value.
So we do this on all of our individual properties within our property fund. And then also when we're talking to particular clients about certain acquisitions, it's something we do base calculation doing exactly this to determine value. And anyone can do that with our properties and our property fund as well. So it's quite a quick and easy method to get you to the value, which the valuers go into a lot of detail on how to value it, but that's just the simple way to determine quickly. So this is a valuation and cap rate example. So you've got a building returning 100,000 in annual rent, and the cap rate is 10%. So it could be 10% is quite a high cap, but it's let's just say it's a quite a risky area. You wouldn't get that in this market at the moment, but for an example, then the value is equal to, so this is how you calculate it, is you go your 100,000 annual rent, so that's your net rent coming from the property, divided by the cap rate, which in this case is 10%. So if you went 100,000 divided by 10%, that will give you your value. So that means this property will be valued at $1 million. So if you're able to improve the building by getting a longer lease or a better tenant, then that's going to reduce the cap rate. So based on what I was saying before about cap rates, is that a valuer will give you a lower cap rate because the building's less risky. So if you've got a longer term lease, better tenant, so you turn the building in from a unknown tenant to a really well-established known operator, then the valuer might say, look, that's really good tenant covenant. So that decreases the cap rate because it reduces risk. So the valuer will apply a higher cap rate. And so by doing that, the rent stays the same, which is 100,000. So you're still getting the same rent, but you've got a better tenant or a longer lease. So it decreases the cap rate to 5%. So now you go 100,000 divided by the new cap rate of 5%, that's 2 million. So you've gone from 1 million to 2 million simply by getting maybe a longer lease or a better tenant to decrease the cap rate.
Yeah, so what we're saying is that people are willing to pay for the first scenario, which is a 10% cap rate. They're willing to pay, they only pay $1 million for that property because it's quite risky. So they want to get it for a really good price. And then the second example is the 5%. So that's something that we would say it'd be a property that you'd buy and forget about. You know, you can't really add any more value to it. So an investor would come along, a very passive type investor, and say, okay, I'm going to pay 2 million because I know that I'm going to get my rent for the next 10 years and it's a fixed rent and there's fixed increases along the way. So it's really a risk factor. And so it's the same property, but because it's less riskier, someone's willing to pay 2 million for it.
Yeah. So that's basically how we apply the formula, and that's to any properties we're looking at. So you might apply that to exactly like that. So you might have a property that's very passive, you don't need to do anything, that's going to attract a much higher cap rate, as opposed to a property that might have IEP issues, short-term leases, weak tenant, and then you pay a higher cap rate, so you've got that value add, which we're always talking about with our fund. So the valuation methodology, so this is what basically valuer would do in terms of how they value the property. So this is the background behind that formula and how that calculation works. So basically, when a valuer is actually undertaking a valuation on a property, he does a similar exercise to that calculation, but goes into a lot more detail. So the way that works is, number one, they work out the net lettable area. So when they're looking at a property, they laser measure the site. So they look at the yard, they look at the amount of warehousing, they look at how big the bathrooms are, how much office is there, how much mezzanine is there, and they apply that on square meter. So how many square meters of each space is there? So that's that, and then how much of that is net lettable. So how much of that is lettable to the tenant or future tenants in the building. So that's the first point of view. Once they've worked that out, they've got their total net lettable area. Then what they do is they go away in the market and they find comparative rents on a square meter basis. So what they do is they compare each item of those areas, so office space, warehouse space, toilets, bathrooms, amenities, mezzanine. They work out each individual square meter rate for each area based on comparative rents in a certain market area. So that could be in East Tamaki. Say the property we're valuing is a property in East Tamaki. We've got Arwen Place in East Tamaki, which is one of our ones in the fund. So they'll go away and compare the rates of rentable square meter in that particular area and come up with a number of different comparables, all with different square meter rates, and they'll come up with the average based on the condition of those other comparables to our one. And so what they come up with is they can determine what the market rent should be. So they've worked out the net lettable area, then they've worked out the rents per square meter to give them a market rent for the particular property they're valuing. So once they've got their market rent, what they then go and do is they go and find comparative sales. So this is to determine the cap rate. So comparative sales, they'll look at certain sales in that same area, say East Tamaki, what properties comparative building, so say 1,500 square meter warehouse has sold for in that particular area. And then they'll get a whole list of properties that have sold, similar properties for the same size and what they've sold for. And then they'll apply a cap rate. And that cap rate they applied will be based on the building in question, how compared to other properties selling, how risky is it? Items like what we've just talked about, how good is the tenant, how secure is the tenant, how long is the lease, are there favorable lease terms, like the tenant can't give 6 months notice to break or anything like that, are the personal guarantees, is it a well-established company? The list goes on to determine that cap rate. So then the valuer will then give that cap rate based on this property, based on other properties, looking at compared to other properties to determine the cap rate to apply to the particular property they're valuing. And then what they'll do is apply that formula. So that's the rent. So they've determined the market rent based on lettable area and comparative rents on a square meter basis. And they'll divide that total rent by the cap rate that they've managed to basically come up with based on comparative evidence, comparing and the strength of the current property that they're valuing. And so that's how they'll do it. Rent divided by the cap rate equals the value. And that's how they'll come up with their overall value to apply to the particular property that they're valuing. So 0.5, so now you know how the valuers operate. So how do you know the cap rates for an area? So that's a question we get quite a lot, because the cap rates do differ in particular areas, especially East Tamaki industrial, Wiri industrial. You can have a lot lower cap rate because there's less vacancy. So that's probably your number one. And so how do you know a cap rate in a certain area? It's always based on sales evidence. So if there's quite a lot of sales, quite a lot of movement in a particular market, that there's a historic cap rates, which a lot of the agencies and a lot of the valuers actually release. So you can see, okay, what is the particular basically cap rate or yield they refer to as being sold in a certain precinct. So that's probably your number one. The other way is the registered valuers. So that's quite hard to get your hands on. But when you are looking at certain properties on the market, sometimes there's a registered valuation that goes with it. And that's the best way to get evidence, or if you've paid for a registered valuation on your particular property. So if you pay for a registered valuation, you'll come up with all the comparative evidence like we just talked about, and you'll have a list of a lot of recent sales in the particular area with all those different cap rates.
And a good way to learn is go onto all the major real estate agent sites or commercial real estate agent sites and press research.
Yep.
And so you can get a lot of free information on areas that you're looking to invest in. And you can get an idea of the cap rates in those areas. You can get an idea of the square meter rates for factory and office and mezzanine. You can learn a heck of a lot by just going through the Bailey's research, JLL research, yep. Colliers, and sign up for their mail lists, and you'll get screeds of pretty useful information coming through.
Yeah, and that'll give you all the different comparative yields. So you'll see them speaking about yields. That's basically the reverse formula of the cap rates in all the different precincts. So you can see your East Tamaki yields, you can see your Wiri yields, you can see your yields in Mount Wellington, and then they compare throughout the country as well. So you can compare Auckland rates to Hamilton, to Queenstown, anywhere you're looking at viewing, and you can see how they differ. So in certain areas like Hamilton, they've got a slightly higher yield because of less demand in that particular area. And then other areas such as Wellington or Christchurch, because the vacancy rate starts to climb up, and you'll see that trend, which especially in college reports, you can actually see the percentage that the vacancy is, and you can see the vacancy, the higher the vacancy, generally speaking, the higher the cap rate or yield is in those particular areas.
So factors affecting the cap rate. So this is what we want to do, is we want to buy a property for quite a high cap rate, and we want to add value to try and reduce that cap rate. So there's a big list here, and you can do one or two or all of them. And if you do all of them, you can do pretty well in commercial property, and you can literally double the value overnight. So yep, so the first one is investor sentiment. So that's a supply and demand for commercial property in a particular area. So if there's a lot of investors wanting to invest in that area, and there's the economy is booming and investor sentiment is good, there's lots of investors competing for not many properties, so that drives the cap rate down. So the second one is, do that one.
Yeah, length of the lease. That's a major one, especially if you can buy a property with the lease that's perhaps running out in 6 months' time. So that's quite a short-term lease, and it might be on only a 3-year initial term. So if you can get a property with a short-term lease, or renew that lease during your due diligence, or before or once you bought the property even, and get a longer term lease and get that tenant to renew, that can substantially decrease the cap rate.
Yeah, and then as Jack talked before, the quality of the tenant is really important, because you can have a no-name tenant, just Joe's building company or something like that, and you can trade that tenant or swap that tenant for someone like Mitre 10 or a big name tenant.
Yeah.
So immediately you're decreasing the cap rate because you're improving the risk in the property. So normally bigger companies like Mitre 10, Fletcher's, companies like that have big financial backers, and they're very unlikely to not pay the rent. Whereas if you've got a small type tenant or unknown tenant who's just a sole operator, there is a risk there that they might get in trouble and not have the finance behind them. So quality of the tenant's really important.
And that goes into the type of guarantee on the lease. So if you've got the tenants like that, like the big name tenants, Mitre 10, companies like that, they've got quite a big backing. So generally speaking, having a tenant like that, you've got a decreased cap rate because of the risk of the tenant. But then you might have another operator. You want to always have some kind of guarantee just in case, because you never know what's going to happen. A lot of companies like that, you might ask for you wouldn't get a personal guarantee out of a big company like that, but having a personal guarantee from the directors of a particular company is one really good way to do it. The other option is having bank guarantees. So if you can have bank guarantees in the lease, that's a defined period of rent. Sometimes it could be 3 months, 6 months, or most commonly 12 months. So a 12-month bank guarantee, meaning that that's a facility that's set up with the bank. So if the tenant ever defaults on rent or any other obligation, you can draw from that bank guarantee. So that's a facility that's set up in your favor. And that's a really good form of security. So if you've got a bank guarantee or even a personal guarantee in the lease, that's again going to lower that cap rate.
Yeah, so it's low, as Jack said, it's lowering the risk of the property if you've got a very, very strong guarantee, and that lowers the cap rate and improves the overall value of the property. So percentage outgoings recovered from the tenant. So this is something that's stated in the lease. So ideally you want to recover 100% from the tenant. So that's all the outgoings for the maintenance of the building as shown in their lease. There is one kind of lease called a triple net lease, which means that the tenant also pays any capital expenses, which is putting a new roof on, recladding, things that the landlord would normally be responsible for. So if you get a triple net lease, that will really lower the cap rate and improve the value of the property.
We have 2 of them in the fund as well. So that's the best type of lease that you can get. So and they're not very common. And the other item is a ratchet clause. So a ratchet clause we touched on last week when we went through leases. So that's the clause that the rent can never fall below the medium ratchet is it can't fall below what it was at the beginning of the lease. The hard ratchet, which is really good to get in these leases, is the rent can never fall. So the rent can never fall below what it is in the immediately preceding year. So that's the best type of ratchet clause. And the harder the ratchet clause you can get into the lease, the again lower the cap rate, because the valuer will say, well, the rent can never fall. So that again reduces risk, which in turn reduces that cap rate.
And the standard clause in the Building Society leases what they call a soft ratchet clause, so it can never go back to the it can only go back to what the rent was at the start of
The lease,
the
very start.
Yeah.
And so like we touched on last week in the lease section, there can be some very long-term leases. Leases can date back, prior to 2010. So if you think about that, the rent could be very low if you've just got a soft ratchet clause.
So structure and condition of the building. So that's pretty important. So when a valuer is looking at the building, they take into account future maintenance. So this can lower the valuation of the building, because they basically take that off the valuation if they've got deferred maintenance. So in terms of the structure, you can to reduce the cap rate or increase the value, you can improve the building by painting it and making it look better. But you can also add, warehouse space or office space, and basically convert office space to warehouse and vice versa. So you can change the structure to improve value and decrease the cap rate.
Yeah, it's a really good way to do it, especially if there's parts of the building that are being underutilized, like canopy or mezzanine space that you can convert to an office or into additional warehouses to up that square meter rate. So that's a really good one. And the other one is frequency of rent reviews. So frequency of rent reviews, if you've got a lease that might only have 1 rent review on renewal, that's quite weak. Or 1 every 5 years, that's also quite weak. If you can get them 1 every 2 years with a hard ratchet, or if you can get rent reviews every year, that's annually. So you could maybe get a lease that has fixed rent reviews of 2% per annum. That's quite strong. And then having a market review on top of that every 3 years or every 2 years even. So fixed increases of 2% plus market rent every 2, that's really good. So the stronger those rent reviews are and the more frequent, again, reducing the risk, in turn, reducing the cap rate in the building. And the last one is the other lease terms. So any other further terms that you could add to a lease that basically de-risks the building and reduces that cap rate can in turn influence the value. And likewise, the opposite can affect. So if you might have a break clause in there, so basically you might allow the tenant to give X amount of notice anytime in the lease. If that's in there, that's going to substantially basically increase the cap rate, because that's a lot of risk, because the valuer will say, well, that tenant can actually give X amount of notice and leave any time. So we've seen that in a few leases. And if that's the case, that's going to really increase that cap rate the other way. So devalue the building. So you've got to be certain all the clauses in a lease and how they affect the risk and in turn the cap rate of the building.
Yeah, so what Jack's saying is that every clause and term in the lease affects the value in some way. So you've got to also, as well as understanding valuations, you've got to understand the lease pretty thoroughly.
So how to improve value? So this is just basically applying the formula that we went through before. So the 100,000 in rent divided by the 5% cap rate equals your 2 million. So basically, if you can increase the rent, so negotiate with the tenant, put more frequent rent reviews, anything along those lines, change mezzanine space to office space or convert more warehousing. That's all items that are going to increase that market rent. So if you can increase that market rent, when you divide that market rent by 5%, you're increasing the value. And the other way is to decrease the cap rate. So basically what we've just mentioned, all of those items, if you can decrease the risk in the property by doing any of those items, then you're decreasing the cap rate. So once again, if you divide current market rent divided by a lower cap rate, then again, you've increased the value.
So the real key and the thing that we've learned over many years is to buy something at a high cap rate, make the improvements and lower the cap rate, and you've got an immediate uplift in valuation and value and rent.
And that's what we're doing with all of our properties in our property fund. So that's a big part of where we differ from a lot of other funds, is we're always looking for properties that we can buy with add value potential. So when we talk about add value, we're talking about properties that are definitely under rented. So we've got upside in rent, or items that we can change in the future. So items like we've just covered on the previous page, like the leases, that we can renegotiate, or areas that we can actually convert to increase that rental space. We're always looking for something that we can add value. So in all the properties we've always got an item in that somehow has got an add value potential, so that that add value is passed on to our investors within our fund.
So yeah, as Jack said, we're our fund Provincia is here to create a diversified portfolio, so spreading the risk over many properties and of add value properties. So we're always increasing the value as we go along, and we like to think within the short to medium term that we'll improve the value of every property we buy for the fund. And our aim is to produce long-term competitive income and capital gain to shareholders. So our strategy is to stick with industrial, and as we mentioned before, value add, invest in areas with sound economics. So it's in areas where there's other industry going on, and population increase, and we'll look at provinces, but only ones that have a good population base and good industry built in.
And we always look at those vacancy rates, because again, that definitely affects the cap rate. So that's something we're always looking at. If we're going to the provinces, what particular areas we're going to invest and what the vacancy rate is, because a higher vacancy rate, once again, will have a higher cap rate as well.
Yeah. So, and we've found our niche is between 5 and 10 million. Anything above that, you start getting into a single tenant with a very, very large rent,
yeah,
and you find it hard to replace that tenant. And it's a fact of life that you do change tenants in commercial property. So you want to be able to do that very easily. And we find that between 5 and 10 million value, we can get new tenants pretty quickly.
And we've proven that over the last few years with our fund, especially after COVID, we've had zero vacancy. Because the tenants that have needed to change, we've been able to change, and there are such great areas that we can change it within a week of, so there's a change over time, which is really good.
Yeah, so Jack and his management team have got a pretty good record since the inception of the fund. When we started in 2017, we've had 100% occupancy of our buildings. There's been no downtime. So that's not a bad track record.
Yeah, sometimes a little bit of overlapping, but that's right.
Okay, so just a little bit about our performance over the last 4 years. So we're just looking at we'll just go to the total return, which is the pre-tax cash return plus the fair value gain, which is a gain in the value of the properties less the liabilities. So 2019, the total return was just over 16%. 2020, the total return was just over 11%. 2021, just over 13%, and 2022, just over 18%. This year, because of the higher interest rates, our pre-tax cash yield is a bit down on what we've previously enjoyed over the last 4 years, but we're looking at probably a total return of around 13%, which is between 3 and 4% pre-tax cash yield at the end of this financial year, and around 10% gain in the value of properties. But they're just forecasted at this stage. So so our biggest mantra is to add value. So that means that our share price will increase over time, providing we have that built-in value in each of the properties. The share price will increase over time and be beneficial for the shareholders. So it's basically inflation proofed. So you're not going to buy in $1 and then at the end 5 or 6 years down the track find that your shares still worth $1. So we like to add value over time. So your what you pay at the start is inflation proofed, and you get a dividend along the way as well.
Well, well, so I think now what we'll do is if there's any questions, Q&A, so we'll open it. If anyone wants to ask us any questions or type in, so that you've just got to unmute your mic if you want to ask direct, or if you want to just type in the chat box. So yeah, feel free to ask us any questions on value add and valuations. There are any?
Yeah, so it's really key to understand valuations. So if you can get hold of commercial valuations, just have a read through them, and you might have a friend that owns a property. It's just a really good idea to get familiar with how the valuation works.
So Grant's just got a question here. How do you value a canopy? So once again, that's a certain area that a valuer will determine when looking at comparative evidence per square metre in a certain area. So for example, we've got canopy space in Arwen, which is our East Tamaki property. They value that. So the canopy, the area below the canopy, they'll measure. So the valuer will measure that area that's covered below the canopy, and he will apply a square metre rate to that. Generally, the square metre they're applying in East Tamaki at the moment for canopy space is about $50 a square metre.
So is that's a little bit more than the yard?
Yeah, slightly more than the yard.
Yeah, so what's the yard?
About $40 a square metre to 45. There are some yards that are creeping up towards that 50, because it's still, the canopy is unsecured as part of the yard. But generally those yards that are $50 a square metre are very well secured yards with electric gates and, really good security. But most common, it's around 40 to 45 per square metre mark for a yard, and about $55 for the covered canopy.
Yeah, so in terms of valuing it, they'd calculate the annual rent for the canopy, and then apply the cap rate.
Correct. Yeah. Well, they'll calculate the annual rent for the canopy and then all the different other areas for that particular building, and then come up with one number, which is the total rent, and then apply the cap rate to that. So that's how the valuation methodology works.
Any more questions? So just another thing to note, remember to go to the real estate agent sites and just have a look at the research, get on the mailing list. They'll send you lots of information that's pretty useful.
And they even apply those market rates per square metre for different areas too, which is a really good one. Really useful to have.
Okay, well, I think we'll wind it up there. Thank you all for attending. And I hope you learned something. If you want to contact either me or Jack, feel free to call us or email us, or email Laura, and we can answer any questions after the webinar in private. And also just letting you know that we are still open for investment. So if anyone wants to invest in our fund, you're welcome to contact us and apply.
Yeah, and next week, 12:30 on Thursday, we'll be covering finance and how to apply for finance with commercial property. We've actually got a guest speaker coming in, so Chris Krishna. He's a mortgage broker, a really good mortgage broker from Mortgage Suite, and he's had 34 years experience with the ANZ. So he's a mortgage broker that we really trust. So he's going to present on financing next Thursday at 12:30. So that'll be great. Thank you.
Okay, thank you. Good afternoon.
Thanks from Hazel and Gus. Thank you.
Thank you, guys. Bye.